Well, first of all, hi everyone. Welcome to this panel where we're going to talk a bit about Anchor. And Anchor is sort of, something that is a really novel approach to building staking derivatives with um, dollar liquidity. But I think one more interesting thing about it is it kind of bridges the gap between proof of stake and DeFi, and it provides a lot of benefits to many different chains and many different protocols. So we have a bunch of great panelists today. We have Zaki from Cosmos/Occlusion. We have Jack from Polkadot. And we have Nick from Terra. And I figure let's start with just maybe a brief intro from each of you and maybe a one-liner of like what brought you into being interested in Anchor.
Sure, I can go first. On my screen, I'm in the upper right. So Zaki, Cosmos, I gave a talk on staking derivatives at Interchain Conversation. I'm getting some feedback on someone's computer, possibly mine. Okay, cool.
Let me mute myself just to be sure. Sorry.
Okay. Cool. Yeah. So or you might edit this. I don't know. Zaki from Occlusion and Cosmos. Been working on the Cosmos project for a while. Been working on proof of stake for a while. Been working on validators for a while. Occlusion, we run validators on the Cosmos Hub and Terra. Selective. We also run a data availability node for Diversify and the Stark DEX. We're slowly expanding the surface area of infrastructure that we run. Have been experiencing the business validators for a long time, have been figuring out like how to deploy proof of stake networks. Back in the summer of 2019, I really started to see the connections between DeFi and staking and sort of the inevitability of sort of financialization of some of these risks. And right now I'm working on a Stargate upgrade to Cosmos, which will bring sort of inter-blockchain communication and sort of an economy on top of Cosmos to life. And so a lot of times people ask like, where is Stargate going? Like what is Stargate do? And I think in many ways it's a Stargate is to like an economy and a financial primitives on top of Cosmos. So excited to be part of Anchor.
Hey, I'm Jack. I can go next. I work at Web3 Foundation and launching a fund focused on kind of the Polkadot ecosystem called Hypersphere. And I've been working on Polkadot stuff for a couple of years. We just recently launched Polkadot last month. And the next steps for us are to launch kind of the sharded architecture so that blockchains can hook up to Polkadot for shared security. And what brings me here today is kind of interest in some of the blockchains that can do that. Terra is kind of going cross-blockchain and built with the Cosmos SDK, but would eventually kind of be bridged to Polkadot using a bridge Chorus One is putting together. And then we have a couple kind of native shards, one called Akala that is super interesting that also has kind of a staking derivative architecture where you can stake your dots through kind of this specific shard or this specific parachain, and then you receive the L.dot token. So we're happy to see an additional, what in this version is called B assets, but I'm sure we're going to go into additional versions of these staking derivatives come to life.
Cool. Yeah, and I'm Nick. I've been leading research at Terra for the past 2.5 years. And a bit of a background about what we've been up to and why we're investing in Anchor and the Interchain Asset Association. So for the first year or so at Terra, our focus was very much on medium of exchange. So We built the chain on Tendermint using the Cosmos SDK, and Terra's being used for e-commerce payments in Korea across dozens of merchants, and we currently have about 1.5 million users. So we've sort of proven the use case to adoption via payments, and recently we've become quite interested in DeFi, and in particular how to make Terra a holding-worthy currency. So something that can give you interest and make it sort of more interoperable with the rest of DeFi. And that's where the motivation for Anchor comes from. Now, pairing this with staking derivatives, the idea has been that basically the ability to leverage block rewards from a variety of different blockchains creates an interesting primitive that could basically subsidize interest for a stablecoin as opposed to purely relying on a market money market, as for example what you see in Compound. And so very excited to be here with you guys and discuss how we can create interoperable DeFi and eventually make Anchor successful not just on the Terra blockchain but on multiple chains like Polkadot, Cosmos, and so on.
Great. And yeah, I guess I think all three of you kind of hinted a little bit at what Anchor does, but I just wanted to give a kind of maybe more direct description. So Anchor is a staking derivative that allows users to borrow Terra USD, which is a stable coin. It's an algorithmic stable coin that uses sort of a combination of a seigniorage-like model and a debt instrument-like model, where the debt instrument is the staking currency. And the staking derivative allows you to borrow against your future expected cash flows, which are your block rewards, from a variety of proof-of-stake currencies. And it's really meant to be like a money market akin to sort of Compound, except instead of borrowing against assets you have right now at a over-collateralized rate, you're borrowing against assets you're going to earn in the future. So it's a lot more similar to what exists in trade finance. And so, in that vein, all of you have spent a bunch of time coming at this from different angles. In Zaki's case, running a validator. In Nick's case, building a stablecoin, so there's a natural reason for a money market. And in Jack's case, working through an ecosystem that has many different types of staking derivatives and flavors. So could each of you, in your own words, explain why Anchor excites you? And I know, Nick, you kind of did say this a little bit already, but hopefully you can find something you missed. And how it impacts the projects you're working on, and sort of where it fits in the grand scheme of what you guys are working on.
You want to take a stab at this, Jack, or I can?
Yeah, absolutely. So from where I kind of spend the most time is in the Polkadot ecosystem. So I can kind of talk about that a little bit more. In Polkadot, it's proof of stake system, and you stake dots. And we have kind of a more aggressive approach to staking. We use kind of this algorithm called nominated proof of stake. And in that, the unbonding period to get your dots back after you stake them is 28 days. So you go, okay, right, I want to stake 10 dots. And then, 3 weeks later, you decide that you need those dots for whatever reason. It will take you, upon deciding that you need those dots for whatever reason, you kind of click the unbond button, and then a 28-day roughly clock starts. So that's not exactly great UX if you quickly want to get liquidity for whatever reason that you might need the funds for. So what really excites me about the potential for additional staking derivatives are to be able to get that liquidity more quickly. And maybe you also want to keep your tokens staked the whole time. And staking derivatives kind of allow you still to have that liquidity to do whatever you want, whether it's taking advantage of other like opportunities that you have or whatnot. But it's really important that if there are multiple staking derivatives, that at least the ones that are used have liquidity, and that you can people actually accept them. Because it's one thing just to get this receipt or this IOU for these these future cash flows, but people actually have to to recognize that they are useful. And I think that's, Anchor seems to be taking a right approach here, in that they're doing it across multiple blockchains, hopefully getting network effects from doing that, and then tapping into kind of non-blockchain users. So it seems like Terra's focused on individuals that maybe just have a smartphone, or individuals who maybe are just more used to like a regular savings rate that's maybe, I don't know, 50 basis points or 1%, and you just keep your money in a bank account, and you're used to having like a steady rate of return for a year or 2 years or 5 years or whatever, which you really can't get with many other staking derivatives as far as I know. So that's one of the reasons. Hopefully it attracts more kind of mainstream adoption for that reason, which brings more people into crypto, expands the pie, which is good for, I think, everybody here.
So one of the things that I think is one of the most sort of drew my attention to staking derivatives almost, and I think is it appears to me that staking derivatives are essential in these now. And the reason why that is the case is because atoms are sort of widely available on many and many of those exchanges will allow you to earn staking rewards just from holding atoms on those exchanges for the period that you hold them until you trade them. And this basically has turned like a big chunk of the liquid atoms that are out there on exchanges into essentially derivatives. And if you want to have parity between like centralized validator ecosystem, a validator business like Occlusion, and the sort of user experience and sort of financial model that is available to people who are staking on centralized exchanges, we need to establish some mechanism for sort of centralized staking derivatives to exist. Otherwise, the inevitable sort of financial gravity towards like every proof of stake network being run by 5 exchanges is that much more powerful. And so that's one of the things that I think is perhaps most exciting to me about all of the work that we're doing on staking derivatives and sort of doing this at the scale that Terra is able to bring, and with the sort of asset that is Terra USD, makes sort of helps actually sort of solve a bit of the challenges that we've always faced in designing these things, which it's actually quite hard to design because of that need for the asset to be widely recognized to get something as robust as that's like competitive with the way a Binance atom is branded as an atom.
Nick, if you want to add anything.
Yeah, I mean, to be honest, I think both Jack and Zach did an excellent job at pitching both, why staking derivatives are interesting and Anchor in particular. So there isn't that much for me to add. I'll say a couple of things. So one is adding a bit to what Jack said. Our focus very much is on making Anchor a very intuitive and predictable product for retail investors to potentially have very little, if not any, experience understanding with. And so that's why a lot of the focus is on delivering a stable interest rate. And as Jack hinted, one of the concerns that we've had with protocols like Compound is that they've established very powerful primitives. But if you look at the rate that someone gets, say, on Circle or on DAI and so on, it tends to be quite cyclical because it leverages demand. And so in bull markets, you have interest rates that are increasing and vice versa for bear markets. And so, for a retail investor who's used to, say, a savings account, that's not very intuitive. And so the idea is to basically have a buffer of block rewards, which you can use to subsidize that rate that depositors can expect. And so even if the rate that lenders are, or sorry, the rate that borrowers are paying might move with leverage. Those broker words help you stabilize that rate, and I think that makes it a much more intuitive product. A separate thought, adding to what Zaki said, is I and the Terra team definitely share his concerns around basically most or a large fraction of liquidity of PoS assets and Bitcoin, in fact, being concentrated on a small number of exchanges. And I think one particular risk which has recently started being discussed, and I think as a community we need to think deeply about and address, is the fact that as a tiny number of exchanges concentrate liquidity, something that may happen as a sort of unintended consequence of this is having a form of hidden inflation, right? Where, taking Bitcoin as the simplest example, if exchanges allow the trading or withdrawals of more Bitcoin than has been deposited, it's possible that no one will notice, and it's possible that actually, in most cases, they're not going to have a bank run. But this, defeats the very principles on which those currencies are built, and it can break fundamental assumptions. And so I think for Bitcoin, as for proof of tickets, and therefore, to Zaki's point, making this a more decentralized process where on-chain you can guarantee that for every B Luna or every B Atom, there is a commensurate amount of the underlying token that's locked up. I think that gives confidence to ecosystem participants, and fundamentally it guards the principles which I think could be in a sort of hidden way broken when focusing on centralized exchanges.
Yeah, for sure. When you were saying that, I was just thinking about how much people trust the funding rate calculations that they're liquidated on derivatives exchanges. You can't really audit them, to be honest. And I'd say 50% of lawsuits against exchanges tend to be on things related to what you're talking about. So I think it might already be here to some extent, where people only notice when it's too late. So, maybe taking a step back, Zaki, you run a validator. Nick and Jack, you guys talk to presumably a bunch of validators. Maybe at a high level, we understand kind of the supply side of the market, which is people who want savings accounts. So they have some funds, they want to earn some interest on it, and they want to do it in a predictable way. But what about the other side of the market, the demand side of the market, the validators who want liquidity? I think it's kind of somewhat intuitive to say, like, okay, from Jack's perspective, 28 days, you're a business, you have to pay Google Cloud or AWS and stuff like that, so you need cash. But because you've spoken with a lot of validators, could you share some details about what are some of the liquidity challenges you've seen and heard of directly, and sort of at what times do they find themselves really needing USD liquidity? And the real reason for asking this is, this market needs both sides to function for it to be super successful. And I think a lot of people kind of understand the supply side more or less, like everyone wants to earn yield risklessly, with quotation marks. But the demand side is actually, it's not as obvious unless you are a validator. So maybe if you guys want to talk a little bit about that.
Yeah, I can talk a little bit about how the economics of running a validator appear to work at this stage of the game. Right now, virtually every validator is cross-chain to some extent. So they manage protocol risk to a certain extent by participating in multiple protocols and multiple and typically right now, increasingly validators have multiple lines of business across multiple ecosystems. So Jack was mentioning the Cosmos SDK to Substrate bridge that Chorus One is running. They're also a validator, but they also are doing this kind of they do kind of engineering work. They have a great product for doing accounting of proof of stake returns called Anthem that I would highly recommend. It's would not have been able to do 2019 taxes without Anthem, or it would have required writing a whole bunch of code. So you have these validators, we have these validators become these like diversified businesses. But I think one of the other things that like validators are doing is they are validator, you are fundamental on the protocols and the assets that you validate on. And what a validator has to do for the year just to, you know, make payroll is constantly manage that long exposure. And right now, our only tool really for long exposure is selling our staking rewards periodically. And so there's like quite a bit of work that goes in, you know, planning when those sales will be, managing a cash. These assets are very volatile, just understanding what to do that. And you sort of see the impacts of that sort of across the economics of a protocol. And I do think that like sort of adding new tools for validators to sort of manage that long exposure is probably healthy and doesn't necessarily result in like sort of a pathological collapse in security.
Yeah, I think one of the things you mentioned there is really interesting is like planning when to sell the assets, right? Like just because I don't know how much like the Venn diagram overlap is between people who are really good at understanding when to sell and people who are really good at running validators is. It's probably not that high, especially right now in the game, I'd say. Like if you're validating on all these networks and you're just getting all these tokens, it's like a lot of risk. Like, and you have to be a risk manager and understand kind of, I mean, you have to be a trader, essentially. You have to be trading these assets. And I don't think many of the validator businesses today are doing that. With the advent of staking derivatives, like the one I mentioned, LDOT, Akala's staking derivative or Anchor, I think that's going to accelerate probably the move to more finance-focused validator groups. But we're starting to see, like many groups came, to Zaki's point, many groups came and said, hey, we're going to be a validator, like this is our business, this is how we add value to the ecosystem. But you're already seeing them having to tangentially go into different other businesses like Cryptium, Chorus One you mentioned. I think it's going to continue to be the case where they're either going to be more dev focused because I think most of the validators today have gotten from like a dev angle, or they're going to be more like trader focused, and because that's how you're going to be able to make a risk adjusted returns on a ongoing basis if you know how to manage that portfolio of assets that you're getting every day. So it's really interesting to see like that happen, especially whenever I feel like the validator, at least the service is kind of almost a race to the bottom in many respects, that they have to make money somewhere else.
Think about the last few.
Yeah, not much to add on my end. I think it's, if you compare, the one thought here is if you compare proof of stake to proof of work, I think one of the innate or inherent disadvantages of proof of stake protocols on the validator side is, as Jack mentioned, the fact that liquidity from the protocol standpoint is quite far out. And so if you compare to proof of work, miners have continuous income stream in terms of mining new coins. And so I think staking derivatives could be, from a sort of ecosystem standpoint, a way to equate some of that difference and to help validators have more of that continuous income stream compared to, say, proof of work miners.
Cool. And this might be more of a quick question. And to Jack's point, I think I had been on this podcast with a bunch of proof of stake people saying exactly the same thing, which is the first generation of validators are probably all going to die, and but the second generation is going to be a bunch of trading firms, kind of very similar to how electronic markets evolved in the late 90s, where like a bunch of the people who built exchanges died, but then a lot of HFT firms turned into exchanges, and BATS being the primary example, and some of the Dutch Bourse now. But I think that's a very poignant observation that's happened multiple times in history. And so it's kind of interesting to see that the analogy kind of come full form. But maybe just a quick hitting question is, given the cross-chain nature and kind of the many liquidity pools that theoretically you can tap, how big do each of you think this pool could get in dollar terms? And do you think it's possible for Anchor to be $1 billion money market?
I have no idea. To be honest, potentially. I mean, I think that would be great into this. I think what we've seen with some of these money markets is the way they're governed, what they're backed by. I think the evolution of that's going to be really interesting. If it's a certain percent Terra, a certain percent Dot, a certain percent Atom, and how that fluctuates based on the success of those networks and who's making those decisions is probably going to be pretty interesting to see happen. But in crypto, I wouldn't probably is the answer.
I was trying to do a few sort of backup calculations as to kind of like the size of sort of the Atom lending market, right? My guess is the Atom money market could probably be imputed to be $1 million in size right now. And so you might be able to hypothesize that. So the question is really, can we 10x that? I guess the dynamics around this, I think, are going to be relatively interesting to see. I think that we're, as we sort of enter the post-Stargate IBC world, the degrees of freedom by which delegators and validators are able to construct and compose economics and cash flow models. Right now, during the bootstrapping phase of Cosmos, the cash flows are all just speculation on future value of atoms and inflation of atoms, because really the network doesn't do very much yet. We're still in the early days. But post IBC, lots of new cash flow possibilities take off, and lots of opportunities for validators to sort of start differentiating themselves also take off by what kind of services that they provide, that their stake atoms run against, and what sort of cash flows get delivered to their delegators. So all in all, I would say, is 10x plausible? I would like to think 10x is plausible. I'm just sort of thinking about all of the sort of staked atoms on exchanges and sort of lending markets and derivatives markets that exist around atoms today. And sort of just, it seems plausible that 10xing that is possible.
Yeah, so in my mind, for Anchor to succeed and become a billion or multi-billion dollar money market, obviously you need to look at both sides of the market, right? And I think so far we've been thinking a lot about the demand, well, depending on what you call demand or supply, demand side being the demand for interest. And so basically attracting as much retail interest as possible and bringing basically mainstream investors who have little or no familiarity with cryptocurrency, having them invest of their product like this, I think is basically the path to a multi-billion dollar demand side. And then of course on the supply side, for those two to be in balance, I think the key is working with guys like Zaki, like Jack, and other proof of stake protocols in order to be able to pool that cross-chain liquidity and to make Anchor a compelling product for validators across chains to gain liquidity. And I think it's the solution sort of lies in the intersection of those two in order to scale to multi-billion dollar.
Cool. Switching gears slightly. So Terra was one of the first launched algorithmic stablecoins that had more or less its own chain. I mean, I guess there were some examples that didn't survive, but the first sort of surviving one, and congratulations, of course. But one question kind of related to this is, you're building this staking money market around an algorithmic stablecoin. And so what are the things that are uniquely enabled by having an algorithmic stablecoin as the base of your money market versus sort of a custodial Circle style stablecoin? And there's a sort of a corollary question. Do you expect custodial stablecoins to somehow still be necessary? Kind of what's kind of their role in this, if any?
Maybe I can take a first stab here. So it's definitely an interesting question. And I think perhaps starting with the second piece, I think custodial stablecoins are obviously the sort of more intuitive and easiest way with which stablecoins came into existence. So, with Tether, I think everyone has had concerns, but the fact that they've been able to establish this network effect, they've been around for many years, they're available in every single exchange. I think it's this network effect which has given them power, as opposed to necessarily the belief that their accounting practices are wise, or even that the future of the ecosystem should lie with centralized stablecoins. So I think sort of the bets are off as to the extent to which they will keep dominating, or we will be able to have stablecoins like Terra have higher market share on the trading side. Because, for context, our focus has been entirely on, for the time being, on means of payment and scaling sort of adoption for payments. And so whether or not Terra or Cell or some other stablecoin is going to dominate or at least steal decent market share from centralized stablecoins in the exchange and trading sphere, I think remains to be seen. And potentially a lot will come down to how we can scale those stablecoins in DeFi. So that's one side. On the earlier question, I think it's, at least from our standpoint, it's less so necessarily about the algorithmic nature of Terra, which enables it to be a good fit for a money market. But I'd say it's more so the question of liquidity. And what I mean by that is more so cross-chain liquidity. So if you think about most centralized stablecoins, most of those have most liquidity on Ethereum, right? And Ethereum has no native proof of stake asset. And so in that sense, having an anchor-like money market on Ethereum is would be quite challenging, right? And basically, I think the advantage here is that if you look at the something like the Terra chain, the fact that you have a native PoS asset as well as a stablecoin makes it much more straightforward to basically bootstrap the system with Luna as the initial Luna and Luna as the initial type of collateral with this algorithmic stablecoin, and then scaling it sort of further. Of course, the key to scaling this will be integrating Atom, integrating Polkadot, and so on. But yeah, I'd say that at the moment, if you look at most centralized stablecoins being on Ethereum, there isn't this sort of existing native PoS assets to bootstrap the system.
Yeah, I'd say the second question, Tarun, I'd be curious what your take is on this. It sounds like you might have something in mind, but I mean, for my part, as far as like the network effects question and what stablecoins are used for, there's a plethora of stablecoins, obviously, and they're all coming at it from different angles. Like Nick just mentioned, kind of the payments angle, and Cell is kind of more open finance, and there's DeFi like stable coins that I'd argue kind of like Maker DAO might be, or in our ecosystem like Akala. And then you have kind of the more trader-like stable coins like USDT, I think is largely used for that. But it comes down to trust and liquidity. And I think people still trust more like, hey, there's some amount of money in a bank account somewhere backing this, if it is one-to-one with the US dollar. And then the liquidity aspect, like how reactive and how much does it incentivize liquidity provisioning, or how reactive is it to demand in the market. So with the biggest stable coin by like, I don't know, feel like it's an order of magnitude, but maybe less. USDT, it's just liquidity. They just have tons of liquidity, and you can get in and out of positions with no slippage, and you more or less trust that some amount of money is in a bank account there, in BPI or wherever else. So it works.
So I guess the way I think about this is so I think the overall dominant effects are like liquidity, number of venues that you have access to for a stable coin, all of these things. But I do think this question of capital efficiency also represents like a pretty big and important piece in the sort of stable coin market. It does seem like if we can make a stable coin that is sort of backed by the robust future cash flows of some proof of stake asset that is running sort of as intended, it will be much more capital efficient than locking up like large amounts of capital in like just like a savings account in a bank account the way USDC works. So there's that. And I guess what's sort of interesting and exciting about Terra to me is like they're one of the first projects to really start experimenting with this architecture.
Great. So we're actually running pretty close to end of our time. So I'm going to try to basically conclude with one question, kind of an overall risk question, asking about the risks that users are taking, because obviously there's no free lunch in these capital efficiency types of things. And I think the last thing is maybe to say something about the Interchain Asset Association, which all three of you are a part of. So, I think I've spent a bunch of time personally thinking about this and writing kind of this paper with Alex Evans on how to try to quantify risk and try to measure whether things are capital efficient or whether there's inequality in systems that have staking derivatives. But when you're building these systems, you have to think about the users who maybe let's pretend they're comfortable using Maker or Compound, which is not, even then that's a very select set of users who are comfortable understanding when they get liquidated, under what conditions kind of they need to move their assets or go top up their collateral. In the staking derivative world, it's even much more complicated. You have the intertwining of price action with future cash flow changes due to getting slashed, due to other conditions that are related to correct participation in these networks. So how do you make the UX of risk palatable to the end user? Because I think this is one of the reasons Compound has grown so much, is that they have figured out a much simpler UX than Maker and other participants for sort of at least kind of managing your risk. So, how do you guys think about it, both from the validator and like the savings account holder perspective?
So one of the things that I think is potentially good about all of this is, in general, I think validators are like sort of under differentiated from the point of view of staking right now. And some protocols are trying to optimize for like making validators sort of this nameless, brandless, undifferentiated like network functionality. But that's never been really my vision for what validators should be. I feel like validators should be like a fairly I do think that, I would like to see more differentiation, and I would, I think I would generally like to see like sort of, stuff like this create like a rating agency for validators that I think actually would probably be would be net healthy for the economy, and also potentially helpful in sort of allowing validators to more effectively compete against the exchanges. So that's one aspect of it. I think that, yes, I think your observation about, having good UX around risk being very important to to the success of any of these instruments is important. And so there's like in general these like information resources that potentially need to happen, but also I think it will be it will help inform, like as we work with the Interchain Assets Association on, you know, the design of Anchor and the evolution of Anchor to keep that in mind.
Yeah, I agree. I mean, and some of the things we talked about earlier, like liquidity, is the UX thing, like how much slippage there is when you can get in and out of positions. But yeah, Compound's done a great job of that, and I think it's critical for like any system that's serious about staking derivatives to get that right, to make it easy to create the B asset and kind of the anchor land. Like what hoops do you have to go through to get that, and then exactly, Tarun, like what's the trust guarantees, or how do the users feel about the potential for loss under a slashing event or a different circumstance like that. And so yeah, really curious to see how that pans out.
Yeah, I think this is an excellent question, and fully agree with what Zaki and Jack just said. So I think on the one hand, when it comes to education and information, I think the Interchain Asset Association can serve a key role in making sure there's enough education, the risks are discussed, and sort of everyone understands that there is significant upside in this technology, but it is definitely very young. And so we're still figuring out exactly how it will become robust. The second piece is that I think until we get to the point where both the systems have been proven to be quite robust, faith in their functionality, developing is quite key, and something that we've been thinking about in a few dimensions. So yeah, without getting into too much detail, I think insurance, both from a slashing standpoint as well as on the liquidation side, is quite key. And so there's always a trade-off, right, between risk and capital efficiency. And I think that potentially in the beginning, it makes sense to sacrifice some capital efficiency in order to have those systems well insured, and then over time sort of give up.
Yeah, definitely. Cool. So, you know, all three of you mentioned the Interchain Asset Association, and so I know we're out of time, but maybe could each of you maybe give a tweet what you would say about your protocol's participation and sort of what you're excited about with it. And it's cool to see kind of different chains working together towards the same goal.
I would say that generally, I think like very much on the top of mind for Cosmos, for Atom holders, is really now that, like, you know, we're on the verge of having an interchain, like the interchain that we imagined when we started working on Cosmos, and with things like Polkadot launching, starting to figure out what is the role of atoms in this ecosystem, and so that's a big part of why I'm like sort of participating in the Interchain Asset Association, is to you know, eventually find is to start working on this process of comparative advantage for the Atom token and like what it does in a world of many blockchains.
Yeah, agreed. I mean, Polkadot is the basic thesis is the world's going to have multiple chains. It's going to be a polychain future. There's going to be chains for different things, from banking to music to finance, to all these things. So we're excited to work with Terra. Definitely excited to work more with Cosmos, using the technology that some of the developer teams straddling different cross-chain ecosystems are building, like the bridges and so forth. And yeah, I'd say the major thing is I don't think we've seen the power of cross-chain because, right, like Cosmos and Polkadot really haven't built it yet. And as those ecosystems get built out, I think we're going to see the power of cross-chain stable coins that can leverage, right, the biggest capital base in the world for crypto, which is Bitcoin, having trustless bridges to Bitcoin, having trustless bridges to Ethereum. In between these cross-chain ecosystems, I think the future looks much more like a web than these siloed individual kind of centers. So I think Terra seems to be on the cutting edge of these developments, and I think it's also a testament to people's change in mindset when they approach building software and crypto. It seems to be much less tribalistic than it was even 6 months, 12 months ago. It's just people making pragmatic decisions about the best software for their solutions. And I think this Anchor is an example of that. So we're excited to be a part of it.
Yeah, I'll keep it concise. In my mind, I think it comes down to having well thought out research as well as governance around how those new technologies will evolve. And yeah, as I think has been a trend in AI, the question around what future do we want here, and how do we plan it in a way that doesn't surprise us with the emergent properties we haven't thought about in advance. I think very much so with DeFi and proof of stake and stake derivatives, the motivation is very similar. And so honored to work with guys like Saiki and Jack. And I think as we expand this association, our ability to think through the challenges as well as increase collaboration to make sure that this ecosystem ends up where we want it to be, as opposed to some version that has much more risk than we wanted to. I think that's the key idea.
Awesome. Well, thanks everyone for tuning in, and hopefully you can ask any of these guys questions on Twitter, presumably. Or if you want to say how best to contact you.
Twitter's great.
Great.
Yeah, at ZMonion on Twitter.
Works.
Cool.
Yeah, maybe we'll do a Q&A after.
Yeah. Well, awesome. Thanks.
Take care, guys. Have a good evening.